You're listening to the Retire Coast podcast, where money, business, and lifestyle come together. Join us each week as we explore smarter financial planning, starting and growing businesses, and building the life you want at every stage, from millennials and Gen X to today's retirees.
Our topic today is about short-term rentals and how to account for them using generally accepted accounting principles and meeting the IRS tests for how you record both income and expenses. Now, this can be a little bit tricky for some of you who haven't done it before. What is it that you have to account for, and when do you have to account for it? Also, we're going to talk about if you stay in your house over a certain number of days, you may not be able to deduct anything, or at least not most things, for example. How about depreciation as it relates to your property? Can you depreciate it entirely? What's the basis of it? We're going to cover all of those things in this podcast. I think you're going to be fascinated by it if you have a short-term rental property now. If you don't, and you're going to get a short-term rental property, you really need to listen to this. This has been derived from an article, a very long article that is full of all kinds of tools and things that we've written on retirecoast.com. You should go and take a look at that article after reading this and get a full understanding of what you need to do. We also have developed an extensive tool, the kind that you have to pay a lot of dollars for, that is located in our business membership area. There is a membership fee, but this tool is worth a lot of money and can actually be your only accounting method if you want it to be, but it can be working with other accounting systems such as Quicken and Wave and some others as well, but it'll help you truly understand how the income flows and if you're profitable and what is reported to the IRS and what goes into the local tax coffers, for example. So we've done this in a dialogue method, like I've done some of mine recently, where two individuals talk about it and they explore different ways that this is going to work for you. So I think you're going to actually get something tremendous out of this. If you're just starting out, this is great for you. If you've been around for a while, this is a double check on the way that you're doing it correctly. So please listen to our dialogue and then come to retirecoast.com and read the article afterwards. Thank you.
You know, we are conditioned from a really, really young age to view a bank statement as just this ultimate objective truth.
Oh, absolutely. It's basically sacred.
Right. It's right up there with checking the weather or like looking at a clock. You log into your banking app on a Friday morning and you see a deposit hit from your real estate side hustle and your brain just delivers this immediate uncritical hit of dopamine.
Oh, yeah, the little green number.
Exactly, the green number. You see a positive number and you inherently think, well, there it is. I made money. The system works.
It's incredibly comforting. I mean, we desperately want our financial lives to be visible and, binary.
Yes, exactly. On or off.
Right. Money in equals success. Money out equals stress.
Yeah.
We basically categorize our entire sense of financial security by those little deposit icons.
But the moment you step into the world of short-term real estate investing, that banking app essentially becomes a weapon of self-deception.
That is a great way to put it.
Yeah, because we are looking at a financial landscape where the deposit is honestly just an illusion.
It is the absolute definition of a financial mirage. Because a deposit is a record of a transaction, right? It's not a measure of profitability.
Right, you're just seeing cash move.
Exactly. What you are seeing is a tiny sliver of the data, completely stripped of all the context you actually need to understand your business.
And that is exactly our mission for this deep dive. Today, we are stripping away that illusion to uncover the true financial reality of owning a short-term rental property.
Which is so needed right now.
It really is. And we are drawing from an incredibly comprehensive guide published by Retire Coast. It's authored by Bill Anderson, and it's titled Short-Term Rental Accounting, a complete guide to tracking income and expenses.
It's a fantastic resource.
Yeah, it really digs into the weeds. So whether you're currently holding a vacation rental in your portfolio right now, or maybe you're analyzing your very first potential acquisition, or, maybe you just have a deep curiosity for the hidden mechanics of how asset management actually functions behind the scenes.
Yeah, just wanting to know how the sausage is made.
Exactly. The goal today is to help you stop guessing and start knowing precisely how an asset is performing.
Because the stakes here aren't just about feeling good on a Friday morning.
Right. It's real money.
If we connect this to the bigger picture, the difference between a hobbyist who is just slowly bleeding capital, and a true sophisticated investor, that difference lies entirely in the mathematics happening outside of that monthly deposit.
Outside the deposit, I love that.
Yeah. If you are only looking at the cash hitting your checking account, you are essentially flying blind in a highly regulated, highly capital-intensive airspace.
Okay, let's unpack this, because the trap is engineered to be invisible. We've all seen the prevailing narrative around this asset class.
Oh, everywhere. TikTok, Instagram, you name it.
Yeah, you acquire a beautiful property in a high-demand market, you syndicate it onto Airbnb, or you hand the keys to a local property management firm.
Right, the passive income dream.
30 days later, a sizable deposit lands in your account. The immediate reflexive investor logic is, fantastic, the asset is cash flowing, I've unlocked passive income.
But that assumption relies on a fundamental misunderstanding of what a short-term rental actually is.
What do you mean?
Well, before we can even touch the accounting, we have to recognize that the terminology we use in everyday conversation, vacation home, beach house, Airbnb.
Yeah, the casual terms.
Right. Those mean absolute nothing to the regulatory bodies overseeing your finances.
Right. The government does not care about your casual vocabulary.
Not even a little bit.
They care about strict legal designations.
Mm-hmm.
The author points out that we really have to draw a hard line in the sand regarding what legally constitutes a short-term rental.
And that line is defined almost entirely by time.
Time. Okay, break that down for us.
The official legal designation of a short-term rental hinges on a very specific threshold. It is a property rented for durations of less than 31 days.
Less than 31. So 30 days and under is the magic window.
Exactly.
Why that specific number? Like, why not 60 days or 14 days?
It's the dividing line between transiency and residency. The moment a guest stays for 31 days or more, the legal and financial framework governing that stay completely flips.
So you cross over into long-term rental territory at day 31.
You do, and that triggers a totally different set of rules regarding allowable tax deductions, depreciation schedules, local lodging taxes.
Wait, lodging taxes change?
Oh, drastically. A 30-day stay might require you to pay a 12% hotel tax to the city. But a 31-day stay might be entirely exempt from that hotel tax because the guest is now legally considered a resident.
That is wild.
And importantly, it changes tenant rights. Evicting someone who has been there 35 days is a vastly different legal process than kicking out a weekender who won't leave.
So the complexity we're dissecting today exists specifically in that highly transient under 31-day window.
Precisely. But time isn't the only threshold here.
Right. The guide makes it clear that the nature of the transaction matters just as much.
A huge factor.
Mm-hmm.
To qualify as an income-producing short-term rental, you have to generate legitimate rental income from third parties.
Third parties. Okay, so this comes down to the concept of, what do they call it? Intent to produce income.
Yeah, intent to produce income.
Mm-hmm.
The IRS is remarkably adept at sniffing out the difference between a genuine business endeavor and, a subsidized personal playground.
Okay, let me push back on this, or at least play devil's advocate for a scenario I know a lot of investors try to navigate.
Let's hear it.
Say I own a ski cabin.
Okay, lucky you.
Right. So I rent it out to my cousin for 2 weeks in the winter, and he throws me, let's say, $1,000 to cover the utilities, the firewood, and a little bit of the mortgage.
Right.
It's under 31 days, money changed hands. Why doesn't that count as short-term rental activity?
Because the IRS looks at transactions between related parties with extreme scrutiny.
Even if he paid me.
Even if he paid you. Because throwing you $1,000 to cover utilities is not a market rate transaction.
I see.
The government views that simply as personal use of the property. To be treated as an income-producing asset, you must be engaged in an arm's-length transaction.
Meaning what, exactly?
Meaning you are charging your cousin the exact same fair market rate you would charge a total stranger off the internet.
Oh, wow. So if a stranger would pay $3,000, my cousin has to pay $3,000.
Exactly. If you offer a friends and family discount that drops the price below market value, you completely compromise the business classification of those rental days.
So the criteria are really strict, under 31 days, and paying fair market value, ideally as an arm's length third party.
That's the baseline.
Okay, so once you meet that criteria, the day-to-day operational reality of the asset is dictated by your management style. And the source contrasts self-managed operations versus professional management.
Which represents a massive fork in the road for how the investor interacts with their own asset.
Yeah, the lifestyle difference is huge. If you are self-managing on a platform like VRBO, you are the chief operating officer, you're the customer service rep, and you're the emergency dispatcher.
You're wearing all the hats.
All of them. You are the one fielding the phone call at 2.0 on a Tuesday because the guest overloaded the plumbing and water is breaching the hallway.
Nightmare scenario.
Right. You are sourcing the emergency plumber at surge pricing. You're coordinating the cleaning crew turnover between, 11.0 a.m. and 4.0 p.m. It is a highly active, operationally intense model.
It is a hospitality job, frankly. It's not passive.
Not at all.
The trade-off, of course, is that you retain absolute control over the pricing algorithms, and you keep a significantly larger percentage of the gross revenue.
Exactly. You kept the manager's cut. Now,
Yeah.
contrast that with the professionally managed route.
Right.
In that scenario, you sleep through the 2.0 a.m. plumbing disaster.
Which is very nice.
The management firm handles the angry guest. They dispatch their internal maintenance team. They schedule the cleaners, and they dynamically adjust the nightly rates.
They do all the heavy lifting.
Yeah, and on the first of the month, they send you a highly polished, official-looking PDF summary of the month's activities alongside a direct deposit.
And that polished PDF is where the most dangerous financial trap in this entire industry is set.
Because it looks so definitive. It looks like a P&L statement, right?
It really does. It's formatted to look exactly like one.
But to understand why it's a trap, we have to look at the core framework the author introduces. The 3 layers of short-term rental accounting.
Yes. I like to conceptualize this not as an iceberg, which is how people usually describe hidden costs.
Okay, what's your analogy?
I like to look at it as the dashboard of a modern car versus the actual engine diagnostics.
Oh, I like that. Let's break that down. Layer 1 is the property manager statement. So this is the dashboard.
Exactly. Layer 1 provides a very narrow operational summary.
What's on it?
It shows your gross rental income. That's the total top-line revenue collected from guests. Then it subtracts only the specific variables the property manager directly controls.
Like what?
That means their commission fee, the cleaning charges they routed to their vendors, and any routine maintenance they handled, like swapping out an air filter or maybe fixing a cabinet hinge. And the bottom line of that statement is your net payout.
The deposit. The number that makes you feel like a genius on Friday morning.
Right. And what's fascinating here is the psychological effect of that document.
Because it arrives with such regularity.
Yes. And because it explicitly uses terms like net income, investors just implicitly trust it as a holistic financial truth.
They think net means everything is accounted for.
Exactly. They look at the dashboard, see the speedometer says 60 miles an hour, and just assume the car's in perfect condition.
Yeah.
But that statement completely ignores layer 2.
Layer 2. The owner-paid expenses. This is the engine diagnostics.
Wow.
The mechanical reality of what it actually costs to keep the machine running, completely out of sight of the property manager.
These are the heavy structural expenses you pay directly out of your own capital.
So things the manager never sees.
Exactly. Your property manager has zero visibility into your mortgage interest. They aren't tracking your annual property taxes.
Right. They don't care about your property tax.
They don't see the specialized commercial insurance premiums required to underwrite a highly transient property.
Not to mention the utilities, if you kept them in your name, the HOA dues, the municipal short-term rental permit fees, or, any of the larger repairs you decide to initiate yourself rather than paying the manager's markup.
Precisely. These are often the most substantial capital drains on the entire operation.
So if you ignore them.
If you are making strategic decisions based on layer 1 alone, you aren't doing accounting. You are just reading a partial receipt and hallucinating a profit margin.
Hallucinating a profit margin. That is a brutal reality check. Which brings us to layer 3, true property performance.
The full picture.
Right. This is where you force the dashboard and the engine diagnostics to actually reconcile. You overlay the operational data from the manager with your out-of-pocket structural reality to find the actual cash flow.
And it's not always pretty.
No, let's bypass the basic arithmetic and look at the actual business impact of this collision using the scenario from the guide.
The margin compression here is what really shocks people.
It really does. So you open your layer 1 statement. Your gross revenue is strong, say it's $6,500.
That's great.
Yeah. After the manager takes their commission and pays the cleaners, they wire you $4,700. Now, the trap is thinking that $4,700 is your yield.
Right.
Because once you submerge into layer 2, paying the mortgage interest, the specialized insurance, the hidden utility spikes from guests running the AC with the doors open, and maybe a contractor repair you paid for, you bleed out another $2,700.
So your true bottom line, your actual net cash flow for that month, is suddenly under $2,000.
You lost over 60% of your gross revenue before you even had a chance to blink.
Yes.
And this is where we really have to analyze investor behavior. If you legitimately believe your property is yielding $4,700 in pure monthly profit because you've mentally compartmentalized the mortgage as just a personal expense rather than a business expense,
Yeah.
what happens?
You suffer from what I call a false CEO mindset.
A false CEO mindset.
Yeah, you assume you have the liquidity and the operational success to over-leverage yourself.
Oh, because you think you have almost $5,000 a month coming in.
Exactly. You use that imaginary cash flow to justify acquiring a second property or a third. Or, equally dangerous, you miscalculate your tax strategy because you aren't aggressively tracking those layer 2 expenses as actual business deductions.
You're just ignoring them.
You are making enterprise-level capital allocation decisions based on middle management operational data.
You're scaling a flawed model. It's like building a skyscraper on a sand foundation.
Exactly.
But here's the truly insidious part. Those massive layer 2 expenses, the taxes, the insurance, the mortgage, those aren't even the only hidden forces compressing your margins.
Oh, not even close.
There is an entirely invisible cost that owners happily trigger every single year without realizing they are actively sabotaging their own P&L.
Ah, yes.
And it is the cost of taking their own vacations.
The collision of personal utility and asset management.
The Retired Coast Guide refers to this as the shadow yield. We really need to explore this because it fundamentally changes how you view the perks of real estate investment.
Yeah, the perk everyone wants.
Right. The primary emotional driver for buying a vacation rental is that you want to use it, but that personal use carries a brutal opportunity cost.
It is the most expensive free vacation you will ever take.
Expensive free vacation. I like that.
Every single night you block off the calendar for yourself, your family, or your friends is a night the asset is paralyzed. It simply cannot generate top-line revenue.
It's like owning a high-end steakhouse and deciding to eat the dry-aged prime rib out of the walk-in cooler every night.
That's a perfect analogy.
Sure, you own the restaurant, you hold the deed to the cooler, the meat absolutely belongs to you. But you cannot act shocked when the monthly reconciliation shows the register is light.
Right.
You didn't just consume the inventory, you consumed the potential profit margin of that inventory.
That analogy hits the underlying mechanism perfectly. You absorb the potential yield, and the guide formalizes this through the calculation of gross shadow income versus net shadow yield.
Right, because we have to look at the business impact of those blocked days with actual math. Let's say your property commands an average daily rate, an ADR, of $250.
Okay.
And you run a solid 65% occupancy throughout the year. If you decide to take a 2-week vacation there, you are instantly vaporizing $3,500 in gross shadow income. You just erased it from the top line.
But to be analytically precise here, you didn't incur the variable costs associated with a paying guest.
That's true. You didn't pay the 20% management commission on that $3,500. You didn't pay the premium cleaning fee to turn the place over.
Right.
So let's say you saved $1,200 in variable costs by staying there yourself. You take the $3,500 in lost gross revenue, subtract the $1,200 in saved variable expenses, and you are left with an adjusted opportunity cost of $2,300.
And that $2,300 is your net shadow yield.
You effectively wrote a check for $2,300 to sleep in your own asset.
And that is strictly the operational consequence of personal use. What is far more dangerous is the regulatory consequence.
Right, because the IRS is watching.
This raises an important question about how the IRS classifies the fundamental nature of your property. We also discussed the 14-day 10% rule, which is formally known as IRS Tax Topic 415.
This blew my mind when I read it, the idea that the IRS actively monitors how many nights I sleep in a bed I own. Walk us through the mechanism of this rule.
Well, the IRS recognizes that wealthy individuals historically used vacation homes as massive tax shelters.
The classic loophole.
Exactly. They would buy a beach house, use it for themselves most of the year, maybe rent it out for a few weeks just to claim it's a business, and then write off all the massive depreciation and operating losses against their high W-2 income.
Must be nice.
It was, but the 14-day rule was engineered specifically to kill that loophole.
So how does it actually trigger?
The IRS dictates that if you use the property for personal purposes for more than 14 days in a year, or 10% of the total days, it is rented to third parties at a fair market price, whichever is greater. The asset is legally reclassified.
Reclassified to what?
It is no longer a pure rental property. It instantly becomes a personal residence with rental use.
Okay, so let's say I hit day 15. I stay for over 2 weeks, just one day over. What actually changes mechanically on my tax return?
The primary mechanism of your tax advantage is instantly capped.
Capped how?
If the property is classified as a personal residence with rental use, your ability to deduct rental expenses is strictly limited to the amount of rental income you generated.
Wait, explain the downstream consequence of that. What does that actually look like in dollars?
Let's use some round numbers. Say your rental generated $20,000 in income for the year, but your total expenses, including your depreciation, your mortgage interest, your repairs, let's say they were $30,000.
Okay, so I operated at a $10,000 loss.
Correct. In a pure rental classification, you might be able to use that $10,000 loss to offset other income you earned that year, like from your day job, lowering your overall tax bracket.
That's the whole point of real estate investing for a lot of people.
Exactly. But if you hit day 15 of personal use, the IRS says, no, your deductions are capped at your $20,000 of income.
So you break even on paper.
Right. And that extra $10,000 in legitimate business losses, you cannot use it to offset your W-2 income. You lose the tax shield simply because you took a slightly longer vacation.
That is a staggering penalty for basically poor calendar management.
It really is.
You are bleeding operational cash through the net shadow yield and simultaneously neutering your own tax strategy.
Which is exactly why personal use must be tracked with the exact same rigor as paying guest stays. You can't just guess.
Wow. Okay, so we've established that daily operations drain capital and your own vacations drain capital.
They do.
So logically, an investor might think, well, the way I win the tax game is by making massive capital improvements. I'll just drop $20,000 on a brand new architectural roof, deduct that massive expense this year, show a huge operational loss, and shield all my income.
And that assumption leads directly into the most catastrophic accounting error an investor can make,
which is
the depreciation trap.
The guide spends a lot of time here emphasizing the difference between current expenses and capital expenditures.
Because it fundamentally violates how normal people think about spending money.
Right. If I spend money, it's an expense.
That's how we think, yes. If you spend $500 fixing a drywall hole caused by an unruly guest, that is a routine repair. You deduct it from your income in the year you spent it. It's a current expense.
Makes sense.
But a $20,000 roof or a full kitchen remodel or upgrading the entire HVAC system, those are capital expenditures. They must be depreciated.
Meaning the tax deduction has to be mathematically carved up and spread out over decades.
Decades, yes.
And for residential real property, the IRS mandates a 27.5-year depreciation schedule for the building structure.
Important caveat here. You depreciate the building, not the land. Land does not depreciate in the eyes of the IRS because, well, it doesn't wear out.
Okay, I understand the IRS logic from a macroeconomic standpoint, but practically speaking, let me push back on this.
Go for it.
If I'm a mom and pop investor and I spend $20,000 gutting and remodeling the kitchen in November, that $20,000 in cash is gone. It has literally left my bank account.
Sure.
Forcing me to track a kitchen renovation over 27.5 separate tax years feels absurdly punitive. I mean, a kitchen doesn't even last 27 years in a highly trafficked short-term rental. Why does the IRS force this mechanism?
You have to look at how the IRS views asset valuation. The IRS does not see a new kitchen as a disappearing expense. They view it as an equity conversion.
An equity conversion.
Yes. You didn't lose $20,000. You traded $20,000 in liquid cash for $20,000 in embedded property equity. You theoretically increased the asset's overall market value and extended its useful life.
So they view it as an asset enhancement, not a business cost.
Exactly. If the IRS allowed investors to deduct a $20,000 capital improvement in a single year, the system would collapse into tax evasion overnight. Investors would just funnel all their profits into structural upgrades at the end of every year to deliberately show a paper loss and pay zero taxes, while simultaneously building a highly valuable, upgraded property portfolio.
Oh, I see. They just constantly upgrade instead of paying taxes.
Right. The 27.5-year schedule forces your tax return to reflect the gradual consumption of that asset's value over time, rather than allowing you to manipulate cash flow volatility to dodge taxes.
Okay, the mechanism makes sense when you phrase it as preventing tax evasion. But there has to be some middle ground, right? What about appliances? A refrigerator isn't part of the physical structure.
There is nuance, which is why a CPA is absolutely mandatory in this business. Certain assets inside the property, like appliances, furniture, or specialized carpeting, can be depreciated on shorter schedules, like 5 or 7 years.
Okay, that's more reasonable.
And there are mechanisms like bonus depreciation or Section 179 expensing that can sometimes accelerate those deductions. But applying those rules requires deep, specialized tax knowledge.
The danger isn't just messing up the current year's taxes, though. The guide highlights that guessing on depreciation creates a ticking time bomb for the exit strategy.
It really does.
Walk us through depreciation recapture, because this sounds terrifying.
This is the brutal math of untangling your tax history.
Yeah.
Let's say you successfully navigate the 27.5-year schedule, taking a few $1,000s in depreciation deductions every year for a decade.
Okay, doing everything right.
You've lowered your taxable income, you've saved money on taxes,
Okay.
Excellent. But then you decide to sell the property.
I cash out. Take my gains.
When you cash out, the IRS requires a final accounting. They essentially say, hey, we allowed you to claim that the property was losing value over the last 10 years to lower your taxes, but you just sold it for a massive profit. So we want those deductions back.
Wait, what?
Yeah, you have to pay taxes on the total amount of depreciation you claimed, or, terrifyingly, the depreciation you were legally required to claim even if you didn't actually take it.
Hold on, wait, if I didn't take the deduction because I didn't know the rule, the IRS still taxes me on it when I sell.
Yes. The rule is allowed or allowable. If you were supposed to be taking it, they tax you upon sale as if you did.
That is brutal.
It's called depreciation recapture, and it is taxed at a specific, often higher rate than standard capital gains. If your accounting system hasn't meticulously tracked these capital improvements and depreciation schedules, the liability you face at the closing table can completely wipe out your perceived profit from the sale.
You could end up owing more than you made.
Easily.
Which proves the point. Routine maintenance equals an immediate deduction. Capital improvements equal a highly strategic, long-term conversation with a qualified CPA.
Absolutely. Do not attempt to guess the useful life of an asset.
So, if tracking structural depreciation is how we protect the asset across decades, how do we evaluate the operational health of the asset right now? We know we can't just look at the gross income on the dashboard. We need better diagnostics.
Right. Day-to-day metrics.
This brings us to the metrics that actually matter, and the trap the author calls the occupancy illusion.
This is where we elevate from defensive tax counting to offensive business strategy.
Let's do it. The guide outlines the standard metrics. We have occupancy rate, the percentage of available nights that are actually booked, average daily rate, or ADR, the raw nightly price, gross income, and, of course, net cash flow.
The standard toolkit.
Right. But the most profound insight here is the inverse relationship between occupancy and profitability.
There is a pervasive, almost instinctual assumption in real estate that a fully booked calendar is the ultimate indicator of success.
Right. If it's booked, you're winning.
The logic seems unassailable. 100% occupancy must equal maximum yield.
But the guide completely dismantles that logic. More bookings do not automatically equate to a healthier business. Let's dive deep into the specific scenarios the author uses to illustrate the balancing act.
Yeah, let's look at scenario A versus scenario B for the exact same asset.
This is the perfect way to understand the invisible drag of high turnover. Okay, so in scenario A, you employ an aggressive volume-based pricing strategy. You price the property at a highly competitive $100 a night.
Very cheap.
You crush the local market, achieving massive booking velocity. You rent the property for 300 nights out of the year. The math is simple. $100 times 300 nights equals a gross income of $30,000.
And on the dashboard, scenario A looks like a masterclass in property management. Your calendar is just a solid block of reservations.
But let's look at the engine diagnostics of scenario A. 300 nights of occupancy means relentless, punishing physical turnover.
Where are the wear and tear?
You are cycling hundreds of different human beings through the property. The HVAC system is running constantly, often with the windows open because guests don't care. The washing machine is doing 3 loads a day every single turnover day.
Luggage is constantly scraping the baseboards. Plumbing is being tested.
Exactly. You are incurring massive spikes in Layer 2 utility and maintenance costs.
Not to mention the operational friction. The sheer probability of a negative guest interaction, a delayed cleaning crew, or a double booking disaster scales linearly with your occupancy rate.
Right, more people, more problems. Now let's pivot to scenario B. You decide to position the exact same asset as a premium experience. You double the price to $200 a night.
Okay, a different strategy.
As a direct result of the higher price point, your booking velocity drops significantly. You only secure 120 nights for the entire year.
That's a huge drop.
It is. Your gross income is $200 times 120 nights, which is $24,000.
So scenario B generated $6,000 less in top-line gross income. Most novice investors would view Scenario B as a total failure because the revenue dropped and the calendar looks empty.
But when you look at the net cash flow, the narrative flips completely. In Scenario B, the property sat empty and dormant for 2/3 of the year.
Right.
The air conditioning was idled, the appliances weren't being worn down, you only paid for 120 days of utility consumption instead of 300. The physical degradation of the asset was minimal.
And because you are dealing with fewer, higher-paying guests, the statistical likelihood of property damage and operational crises plummets.
Exactly. When you subtract the drastically lower Layer 2 operating expenses of Scenario B from its $24,000 gross, it frequently results in a significantly higher net cash flow than Scenario A's $30,000 gross.
You literally make more real money by working less and keeping the property empty more often.
Which feels so counterintuitive.
It does, but chasing 100% occupancy is mathematically irrational for most properties.
Which is why the hospitality industry relies on a much more sophisticated diagnostic metric.
Right, RevPAR, revenue per available rental day.
Explain RevPAR.
RevPAR doesn't just look at how full you are or how much you charge. It mathematically blends occupancy and rate to evaluate how efficiently you are monetizing the time the asset exists.
It forces you to evaluate the quality of your revenue, not just the sheer volume.
Exactly. Quality over quantity.
But here is the operational bottleneck. To track metrics like RevPAR, to monitor margin compression, to analyze net cash flow, you need an actual accounting system.
You can't just wing it.
You cannot run these diagnostics in your head, and you certainly cannot run them by scrolling through your banking app.
The guide transitions nicely here to the structural requirements of setting up these systems, navigating IRS reporting traps, and preventing audit triggers.
Let's start with the foundational architecture of the accounting system. The author contrasts cash accounting versus accrual accounting. What is the functional difference, and why does the guide strongly recommend one over the other for the typical investor?
Well, the distinction lies in the timing of how you recognize financial events.
Okay.
Cash accounting is purely chronological based on liquidity. You record income on the exact day the money physically clears into your bank account. You record an expense on the exact day the funds leave your account. It perfectly mirrors the reality of your cash flow.
So if I swipe my credit card for a new water heater in December, but I don't pay the credit card bill until January, under cash accounting, when does the expense happen?
It happens in December when the transaction actually occurred.
Got it.
Now, accrual accounting is vastly more complex. It requires you to record income when it is earned and expenses when they are incurred, completely independent of when the actual cash moves. So if a guest books a stay in October and pays a deposit, but their actual vacation isn't until February,
an accrual system might require you to defer recognizing that revenue until February when the service is actually provided.
Oh, that sounds complicated.
It is a highly accurate way to view long-term corporate liabilities. But as the author makes abundantly clear, accrual accounting is massive overkill for a standard short-term rental investor.
Yeah, that seems like too much work.
It creates a massive disconnect between your accounting software and your actual bank balance. Cash accounting is intuitive, it matches your statements, and it is perfectly acceptable to the IRS for properties of this scale.
So we stick to cash accounting, keep the architecture simple.
Always.
And the tools required to manage this don't have to bleed your margins either. The guide provides a really pragmatic breakdown of the software landscape. You don't need enterprise-level software to track a single beach house.
Exactly. They highlight platforms like Wave and Stessa, which operate on a $0 per month freemium model. They are cloud-based, they sync with your bank, and they handle core income and expense categorization perfectly. The author specifically notes they've used Wave personally for years.
It's a great tool. Then you have the industry standard, QuickBooks Online, which runs around $35 a month.
Is QuickBooks necessary for everyone?
QuickBooks is exceptionally powerful, but it's really designed for complex LLC structures, multiple equity partners, and intricate payroll requirements. If you're just starting out, it might be too heavy.
And crucially, RetireCoast offers their own STR income and expense review tool as part of their business membership. And the value prop of that tool specifically addresses the blind spot we talked about earlier.
The Layer 1 versus Layer 2 issue.
Yes, it is engineered to bridge that exact gap. It forces the property manager's dashboard data to integrate with the owner's engine diagnostic data.
Regardless of the software stack you deploy, the integrity of the data relies entirely on adhering to fundamental accounting principles.
Right. The guide touches on GAAP, generally accepted accounting principles. which sounds like a semester of college I want to skip.
It can be very dry.
But broken down for a rental owner, it's really just 4 operational commandments.
1, matching. You strive to align your income with the specific expenses that generated it.
Makes sense.
2, consistency. You can categorize pest control as maintenance in Q1 and utilities in Q2. The tax code requires historical consistency.
Pick a lane and stay in it.
3, proper documentation. A credit card statement is not a receipt. You need the itemized invoice to survive an audit.
And commandment number 4, which is arguably the most violated rule in the entire sector, separating business from personal.
Commingling funds is the cardinal sin of small business accounting.
Let's walk through the disaster scenario of commingling, because people do this all the time.
Oh, constantly.
You have one personal checking account. Your W-2 salary goes in there. Your Airbnb deposits go in there.
Everything in one pot.
You use the debit card to buy groceries for your family, and then you use the exact same debit card to buy $400 worth of towels for the rental property.
You have just created a forensic nightmare.
Why?
If the IRS initiates an audit, they're going to look at that bank statement and demand you prove which of those hundreds of transactions were for the business.
And I assume they don't take your word for it.
They absolutely do not.
Mm-hmm.
The burden of proof is entirely on you. Furthermore, if you are operating the rental under an LLC for liability protection, commingling funds pierces the corporate veil.
Pierces the veil. That's lawyer talk.
It is. A lawyer suing, you could argue your LLC is a sham because you treat the business account like a personal piggy bank, exposing all your personal assets to the lawsuit.
Your house, your car.
Everything. The fix is so simple. Open a dedicated business checking account. All rental income goes in there. All rental expenses are paid from there, period.
It creates a clean, isolated financial ecosystem. Exactly.
Okay, so let's assume the listener's doing everything right. They have a separate bank account. They are using a free tool like Waze. They're operating on a cash basis. They're tracking layer 2. They feel like a really sophisticated operator.
They're feeling confident.
And then late January rolls around and they get hit with what the guide calls the 1099 shocker.
Oh, this one catches everyone.
This is the primary IRS reporting trap that catches almost everyone using a property manager or a platform like Airbnb.
This raises an important question about the mechanics of IRS data matching algorithms.
Okay.
If you misunderstand how third parties report your income to the government, an automated audit is virtually guaranteed.
Break down the mechanics of the 1099 trap for us.
Let's return to the math of our property from earlier. Over the course of the tax year, your property generated $60,000 in total top-line bookings. That's the gross income.
Wow, great year. However, your property manager retained their 20% commission, they paid the cleaning crews out of those funds, and they withheld money for a few plumbing repairs. As a result, the total cash they actually deposited into your dedicated business checking account over the entire year was only $40,000.
So as a responsible operator using cash accounting, I look at my bank ledger. I see $40,000 in receipts.
Exactly. You then subtract your layer 2 expenses, your $30,000 in mortgage, interest, taxes, and insurance. You calculate your net profit as $10,000.
Right.
When it's time to file your Schedule E tax form, the logical, intuitive move is to report the $40,000 deposit as your rental income.
It perfectly matches my bank statement. It feels completely honest.
But here's the shocker. By law, at the end of the year, your property manager or the booking platform must issue a form 1099 MISC or 1099 NEC to both you and the IRS.
Okay.
And that 1099 does not report the $40,000 of net cash they wired to you. It reports the 100% gross income. It officially tells the IRS that your business generated $60,000.
So let's look at this from the perspective of the IRS mainframe. The computer receives an official document saying this taxpayer earned $60,000, but my tax return comes in saying I earned $40,000.
The algorithm instantly flags the discrepancy.
Automatically.
To the IRS computer, it appears as though you were deliberately concealing $20,000 of taxable income. It triggers an automatic CP2000 notice, proposing additional taxes, severe penalties, and interest on that missing $20,000.
It's like walking into a casino with $50,000 of your own money.
A great way to picture it.
You sit at the blackjack table, play for hours, and you win $60,000 in hands, but you lose $50,000 in hands. So you walk away with $10,000 in actual profit.
Right.
But the IRS only looks at the gross winnings. They say, congratulations, you won $60,000. Pay us taxes on $60,000. And you have to frantically produce the receipts to prove, no, I had to spend $50,000 to win that money. The gross number is completely misleading.
The mechanism of defense is precise reporting. You must report the full $60,000 gross income on the top line of your Schedule E.
Even though you never saw it.
Exactly. Then you must explicitly itemize the $20,000 in property manager commissions and platform fees as deductible expenses, right alongside your Layer 2 mortgage and insurance deductions.
You have to prove the math on the tax return itself to bridge the gap between the 1099 gross and your actual bank deposits.
You have to force the IRS to see the engine diagnostics, not just the dashboard.
That is an incredibly specific, high-stakes reporting requirement. And the guide makes a very ominous point that this level of scrutiny isn't just coming from the federal level anymore.
No, local enforcement is becoming ruthlessly efficient.
The landscape of municipal tax enforcement has shifted radically in the last, 36 months?
Easily. Cities and counties have realized that unregistered short-term rentals represent millions of dollars in lost transient occupancy taxes and lodging fees.
The days of quietly running an Airbnb off the books in your basement are completely over. The guide explicitly details how municipalities are deploying AI and automated data matching algorithms.
They are contracting with third-party tech firms that programmatically scrape the internet.
Scrape the internet, like looking for my listing.
Yes, these algorithms crawl Airbnb, VRBO, Booking.com, and even Facebook Marketplace. They analyze listing photos, cross-reference GPS metadata, and match those listings directly against county property tax rolls and permit databases.
So they don't even need to send an inspector to your street.
No, a server in another state is mathematically proving that your property is generating unreported lodging revenue.
That is terrifyingly efficient.
Exactly. And because it's a fully transparent digital economy, the systems are beginning to talk to each other.
What do you mean?
If you correctly report your 1099 gross income to the IRS to avoid federal evasion, but you conveniently fail to remit the 12% hotel tax to your local city council, those data sets can and will be cross-referenced.
AI data matching means holistic compliance is the only viable operating model.
There is no hiding anymore.
So when we aggregate all of this, from the regulatory nuances of the 31-day rule to the margin compression of Layer 2, the net shadow yield of personal use, the 27.5-year depreciation trap, the Rev Pierre metrics, and the algorithmic precision of modern tax audits.
It's a lot to take in.
It is abundantly clear why well-meaning investors stumble into catastrophic financial errors.
It's a minefield.
Which brings us to the synthesis of the guide. Let's systematically review the top 5 mistakes owners make, and more importantly, the psychological flaw driving them.
The author distills the entire complex ecosystem into 5 primary failures.
Let's run through them.
Mistake number 1. Focusing only on deposits. Believing the Layer 1 dashboard is a true reflection of profitability.
Mistake number 2. Ignoring owner-paid expenses. The failure to accurately track the heavy structural Layer 2 costs like specialized insurance and mortgage interest.
Mistake number 3. Lacking a consistent tracking system. Relying on an amalgamation of bank feeds, shoeboxes, and panic in early April.
Panic in April, the true American pastime. Mistake number 4. Misunderstanding the tax rules. Assuming a major kitchen renovation is an immediate write-off, or ignoring the devastating tax consequences of violating the 14-day personal use limit.
And mistake number 5, which really encompasses all the others, treating the short-term rental like a passive side hobby instead of an active, highly regulated micro-business.
What I find most fascinating about this list is that these aren't fundamentally accounting errors. They are behavioral errors.
They absolutely are.
They all stem from one psychological flaw.
Compartmentalization.
Exactly. Investors actively compartmentalize the data because the truth is often uncomfortable.
It hurts to look at.
They keep the property manager's polished PDF statements neatly filed in an email folder because it makes them feel successful. They keep the painful mortgage payments isolated in a separate banking portal. They throw the Home Depot receipts for repairs into a physical drawer.
The data sets are intentionally kept apart.
And when data systems are isolated, you cannot perceive reality. You are left with a fragmented, distorted view of the asset. The entire path forward, the core thesis of the Retire Coast methodology, is integration.
Integration forces clarity. This is why specialized frameworks, like the STR income and expense review tool we mentioned, are so critical.
It acts as a mandatory reconciliation layer.
It forces you to take the optimistic Layer 1 data and crash it directly into the harsh Layer 2 reality.
By utilizing a framework like that, Ideally paired with a free ledger tool like Wave, you eliminate the compartmentalization.
You generate clean, integrated, holistic data that you can then hand to a specialized CPA.
And the behavioral shift that occurs is profound. By connecting Layer 1 and Layer 2, the owner stops being a passive passenger who just hopes the Friday deposits eventually cover the mortgage.
Right, they take control.
They transform into the active CEO of their asset, capable of making strategic decisions based on true net cash flow and RevPAR metrics.
Which is how you actually build wealth.
So let's synthesize the core mandate for the listener. We have dismantled the illusion of the bank deposit. We've established that true real estate accounting is not simply an administrative chore you endure to appease the IRS.
Not at all.
It is the fundamental diagnostic system required to see the 3D reality of your investment. It demands absolute separation of business and personal capital.
Never commingle.
It requires a deep respect for the mechanisms of depreciation, the opportunity cost of personal use, and the specific reporting traps of a 1099 gross data.
You cannot operate successfully by only looking at the tip of the spear. You have to understand the entire mechanism.
So what does this all mean for you? Whether you are actively managing a portfolio of beachfront properties, or you are simply trying to apply better diagnostic rigor to your own personal financial life, the ultimate lesson of this deep dive is identical. True clarity is rarely comfortable, and it requires looking at the entirety of the data, not just the isolated metrics that validate your assumptions.
And I want to leave you with a final, broader implication to consider.
Good deal.
We have spent this time examining accounting as a tool for measuring profit and minimizing tax liability. But consider the trajectory of the regulatory environment we just discussed.
The AI tracking.
Yes. If municipalities and the IRS are increasingly deploying sophisticated AI algorithms to scrape internet listings, cross-reference property metadata, and automatically detect unreported yield, at what point does your accounting system stop functioning merely as a financial diagnostic and start serving as your absolute solitary line of legal defense in a fully automated, fully transparent digital economy?
When the algorithms come auditing, you better have the engine diagnostics to prove your reality. Thank you for joining us on this deep dive into the true operational mechanics of the vacation rental market. Keep learning, keep challenging the dashboard metrics, and above all, keep unpacking the numbers.
Thank you for coming to Retire Coast podcast and listening to our latest on short-term rental accounting. Again, please go to retirecoast.com and read the entire article. You can see the link in the show notes for this podcast, and I hope you come back and listen to other podcasts. We have many of them. We are already serving more than 100 countries and individuals in thousands of cities across the world. So I appreciate all of you who are listening, and please come back. I think that if you can leave some comments, that would be great for us. It'll let us know if we're going in the right direction for you. Thank you.